Stop what you're doing. If you own or are looking at regional bank stocks right now, you need to hear this 5-model valuation breakdown. Welcome to The Explainer. Last week, I ran Enterprise Financial Services Corp, or EFSC, through 5 valuation models and 2 legendary checklists, and what I found actually shocked me. We're looking at a scenario where a bank's intrinsic hard asset value is projected to compound at nearly 15%, while the broader market is practically asleep at the wheel. Now, I know the feeling. It's the ultimate retail investor pain point, right? You watch a stock report solid profits, and then its share price just sits there, doing absolutely nothing. It makes you feel like the market knows something you don't. But by the end of this explainer, you're going to know exactly if EFSC is a Warren Buffett buy or a Peter Lynch value trap. We're going to build a clear, actionable framework you can steal to cut through all the Wall Street noise. We're going to look at the fundamental architecture of this regional bank and figure out what the market is truly pricing in. Okay. Let's dive into the immediate tension. There's this undeniable accounting tug-of-war happening right now in EFSC's Q1 report. On one side, we've got a pretty blatant top-line revenue mess. They reported $185.2 million, which, even though it's a 10% increase year over year, it still fell short of Wall Street's expectations. But countering that is a rock-solid bottom-line earnings per share beat. They brought in $1.30 per diluted common share, edging out analyst consensus. So let me ask you a bold question. What happens when a multi-billion-dollar financial engine pumps out a massive profit beat but completely misses on top-line revenue in a highly volatile interest rate environment? Well, Wall Street short circuits. And how exactly did investors react to this short circuit? They basically shrugged. The stock totally flatlined at $57.54 right after the earnings dropped. It is a perfect example of how complex, conflicting financial disclosures can just paralyze price action in the short term. Is that $57.54 price tag a massive value trap or an incredible discount on a compounding machine? To grasp that, we can't just stare at the stock ticker. We really have to open up the hood.
Section 1, Engine Inspection. How EFSC makes money.
EFSC's operational reality really starts with its physical footprint. At its core, Enterprise Financial Services is a Midwest-focused commercial bank. They're headquartered in Clayton, Missouri, and they manage a really robust $17.2 billion in total assets. But here's the kicker. They aren't just confined to the Midwest. Their reach actually extends through national deposit and loan production offices in key markets, places like Phoenix, Los Angeles, Las Vegas, San Diego, and Dallas. So you've got this solid regional foundation combined with a powerful national growth lever. So who exactly are they lending all this money to? Well, their revenue engine gets its fuel from highly specialized lending verticals that specifically target privately owned businesses. We're talking SBA 7A lending, sponsor finance, tax credits, and even life insurance premium finance, right alongside your traditional commercial real estate. And this matters immensely. It proves this isn't just your standard sleepy neighborhood savings and loan. It's a highly diversified commercial operation. Section 2, Q1 2026 Financial Data Blitz. All right, first up, the bottom line. $1.30. This is the Q1 net income per diluted common share. Like we touched on a minute ago, this narrowly topped consensus estimates. And yeah, while it is down a little bit from the $1.45 they posted in the previous quarter, it proves one really important thing: resilient profitability in a highly complex economic environment. Now, the crucial point here is their net interest income of $166.1 million. Net interest income, or NII, is literally the lifeblood of a commercial bank. It's the difference between the revenue generated from their assets, like loans, and the expenses of their liabilities, like paying interest to depositors. While this $166.1 million was a slight decrease of $2 million from the prior quarter, it actually still narrowly exceeded analyst expectations for the quarter. And driving that income is their net interest margin, which brings us to an impressive 4.28%. Think about this for a second. In a quarter where so many banks were feeling a heavy squeeze on their margins, EFSC actually reported a positive quarterly increase of 2 basis points. Maintaining and slightly growing that margin above 4% is a massive signal of effective balance sheet management. Let's bring a human element to these numbers. President and CEO Jim Lally summarized the quarter directly, pointing exactly to that stable net interest margin and improved credit quality. And management is absolutely backing up that confidence with a 1.16% return on average assets. That tells us they have a very tight grip on the steering wheel, and they're easily navigating seasonal loan and deposit trends. Plus, management isn't just talking a good game, they are actively putting capital back into the hands of shareholders. Despite the totally flat market reaction to the stock price, EFSC increased their quarterly dividend by a penny to $0.34 per share, which pushes their dividend yield to a pretty attractive 2.31%. On top of that, they're continuing their share repurchases. They're essentially telling the market, hey, if you won't buy our stock at this price, we absolutely will. Section 3. The Valuation Climax. Tangible Book Value.
Okay, tangible bank value per share, or TBVPS, is basically the ultimate tool for cutting through all the banking accounting noise. Traditional metrics like EPS can face heavy distortion from M&A activity and weird loan loss rules. But TBVPS, it strips out intangible assets, like goodwill from previous acquisitions, giving us a crystal clear North Star for the bank's true hard asset worth per share. When you're analyzing banks, this metric has to take absolute precedence.
And looking at EFSC's track record here is, honestly, eye-opening. While they technically missed Q1 TBVPS estimates by just a hair, look at their historical trajectory. Over the past 10 years, they have grown their tangible book value per share at an exceptional 9.8% compound annual growth rate. The last 2 years show an even steeper trajectory, growing 10% annually from $34.21 to $41.38 per share. And looking forward, consensus estimates project this will rise by 14.7% to $47.47 over the next 12 months. That is a seriously compelling growth rate for such a fundamental value metric.
Section 4. Future Outlook and Macro Risks. Now, to be completely impartial, diving into the company's SEC filings, management explicitly outlines several forward-looking risks, keeping our expectations grounded in reality. These include the wild cards of rapid interest rate shifts, which of course directly threaten that net interest margin we just talked about. They also highlight the burden of persistent inflation, challenges in retaining deposits, and broader geopolitical matters. They specifically cite conflicts in Israel, Iran, and Ukraine, which could heavily disrupt global economic growth. Which leaves us with one incredibly pivotal question. How will these massive macroeconomic risks impact EFSC's projected 14.7% tangible book value growth? They've got this specialized lending engine, a national footprint, and a ruthless history of compounding value. But they are sailing straight into a perfect storm of global economic headwinds. So will their historical execution be enough to protect that fundamental value, or is the macro environment going to tear it down? That is for you, the focused learner, to decide. Thanks for joining me for this explainer, and keep asking the right questions.